I have an apology to make because I was thinking I was winging it this morning and I forgot that I needed to introduce Linda, and so I did not print off my introduction. So I'm going to have to do it in my own style. I met Linda in Turlock a few months ago at an event, and I was with Kimmer, and we were just totally blown away by the passion that Linda has for helping people get out of debt. I mean, wow, she just was on fire with it, and we couldn't believe how wonderful she is. I know that Linda spent 23 years in the Navy. She has a Bachelor of Science in Finance, and she's been in the financial services industry for 4 years. She's a wonderfully friendly, helpful person who I love dearly. She's lots of fun, and you're going to love her presentation. She's going to educate you about money. Please help me welcome Linda Bowen.
All right. Okay. Good afternoon, good morning. How's everybody doing?
Good morning, good afternoon.
How's everybody doing? Good?
Good.
Good. It's good to be here. Thank you, Barbara. Barbara and Kimmer are the reason why, I'm here, and they saw something in what I was presenting to them that they wanted me to duplicate and present here, and I'm honored today to be here to share this with you. So again, my name is Linda Bowen, and I'm with Primerica. And for the past several years, I've had the privilege and the pleasure of traveling around to multiple states and around this area as well, talking to people about money, talking to people about the truth about how money works. And in that process, I am very well aware that there's a lot of things that people don't need, and there are a few things that people do need. And I've sat down with hundreds of families in this process, and what I want to share with you is some things that I've learned. So, I don't think that that people need some sort of, goofy sales pitch, talk about financial services, and we've all had enough of that, right?
Oh yeah.
And I don't think that people need another financial product. And I don't think that people need their time wasted. But there's a few things that people do need. And people need the truth. People need the truth, and they need the facts about how money works. Because what I've learned in this process is that once people have the truth and the facts, they can make the best decisions. So if you take someone who is genius, brilliant, right? Absolutely amazing, and they're missing key information, they're probably not going to be able to make the best decision, right? But you can take someone of average intelligence, someone who, maybe hasn't had a lot of schooling, and if you give them the truth and you give them the facts, they can come to the best decision. Would you agree with that?
Right.
So what I'm here to do today is just to share with you what I've learned is there's really 3 reasons. In financial services, there's really 3 reasons why people don't do the best with their money, okay? And let me tell you what it's not. It's not that people don't work hard, right? Does everybody, you think everybody works hard, right?
Right.
Yeah. For the most part.
And it's not that people can't learn. It's not that people don't have the ability to learn. It's that we have a failure to plan, okay? That's the number one reason that people don't do the best with their money. And people are uninformed. And people are misinformed. And that's different, okay? So, failure to plan, we're going to start with that. So how many of you have ever been to a wedding? Show of hands, okay. How many of you, what would you think, how much time is the actual event, the wedding? Like, from the time that the bride and groom gets up in the morning, they get dressed and ready, they go and you have a ceremony, you have, you know, they have everything, they leave in the limo to their honeymoon. How many hours, how long do you think that event, the actual event, 10 hours? 12 hours? Okay? 10 to 12 hours, would you all agree? It's probably roughly 10 to 12 hours, okay? How long does the bride and her mother spend planning for that 12-hour event?
10 months?
Is it 12, 6 months or a year or something like that?
A year.
A year to 18 months.
Yeah, 10 to 12 months. So let me ask you. We spend, on average, 10 to 12 months planning a 10 to 12-hour event. Yeah? How long does the typical family spend planning for their retirement?
0.
15 minutes? Would you all agree? Okay, so 15 minutes? Not very much, right? So, how long is a typical retirement?
20 years? 20. 30 years?
20 years, 30 years? At least 15. Would you agree? At least 15 years. If you retire at age 65 and you live to age 80, that's at least 15 years. 15, 23 years. And how much time do we spend planning for that?
15 minutes. 15 years.
So would you agree that one of the top reasons that we're not doing as well with our finances, failure to plan?
Yes.
Okay? The second reason is people are uninformed. So let's just talk about that. Where do we get our knowledge about finances?
Parents.
Parents?
Media?
Stockbroker and accountant?
Media?
Media? TV? Okay, I'm sorry, I didn't hear.
Credit card company.
Credit card companies?
Work.
Work?
Yes, exactly.
Okay, so the way that we are getting the information about how money works, basically, we're getting it from other people, right? From our peers, from our parents. Our system is school, college, workforce, right? Or at least school workforce, but school, college, workforce. Where in that process did we learn the rule of 72?
When I bought my first house.
When you bought your first house? How many of you in this room know the rule of 72? Raise a hand. Okay? So, less than half of the room. So, uninformed, and I'll show that to you. I'll show you, we'll be talking about that in just a few minutes. The power, and if the rule of 72 basically states that whatever interest rate you're earning on your money, you divide that number into 72, and that's how many years it takes your money to double. So if we have the capability to double our money over time, shouldn't we know about that? Shouldn't somebody sit down and like talk to us about that? That would be a good thing, right? And then misinformed. That's different because a lot of times we're informed, right? We're informed, parents, TV, media, but you can't give somebody something that you don't have. So if you never got a good, solid financial education and you're not doing the best with your money, how many of you in this room, by show of hands, feel that you're doing the very best with your money? Anybody? Okay, the very best.
Yeah.
Would you agree that there's room for improvement?
Yes.
Okay, and so what we have is we have an industry, financial services industry as a whole. Let's just talk about the banking industry. What's the I don't know. What's the goal? What's their mission statement? What's the mission statement of the banks?
To make money.
To make money, right? To get all the money they can. Okay? So their goal is to stay in business. And how do they stay in business? By charging fees, right? By taking our money and doing other things with it, right? So if we're getting our financial advice from them, you think maybe it's skewed a little bit?
Yes.
You know, it's not a win-win in all situations. Would you agree with that? Okay, so we're going to talk about these three things. These three reasons as I go through my presentation. What we want to do is we want to build a financial house, okay? And has anyone ever built a house before? A real house. What's the most important aspect of that house?
Foundation.
The foundation, okay? So the foundation of the house is income protection. Because what is your most valuable resource? Yourself. Yourself. Your income. Your ability to earn income. And when I sit down with families, the most common question, the most common answer I get to that question is my house, my kids, you know, and that's true. That's the misinformation, because unless you own your house outright, whose asset is that?
The banks.
The banks, right? It's a liability on your income statement. That's a liability. It's only an asset on the bank's balance sheet, right? So your ability to earn income is your largest asset. So I want to do just some quick calculations in your mind if you'll play along with me. What's the average work years? I mean, we normally work from age 25 to 65 or somewhere around there? 40 years, 40 to 50 years average. Would you agree?
Yes.
So if you're working 40 to 50 years, and what's the average income? Nationwide, it just dropped. In the last decade, it's actually gone down. So it's under 50,000 now. But we'll just use 50,000 because the math is easy. So if you average, let's just say you have an average income, okay? And this is very conservative. Why? Because we're going to say that in 40 to 50 years, if you're working lifetime, you never got a pay raise, and you never promoted. So you're just an average person, right, for the whole 40, 50 years. So if you work 40 years and you average 50,000, what's the income that came into your household? 2 million, right? years. If you work 50 years, 2.5 million? Is my math good? Okay, 2.5 million. You tell me one asset that you have right now that's worth 2 million, 2.5 million. Do you have one other than yourself, your ability to earn it? Right? So, the next step, as we're building our financial house, then we have to make sure that we have a good solid foundation to protect that, right? Because if you're building a house and you try to, put the electrical in before you put the frame in, it's not going to work, right? So everything has a sequence, everything has order. So next on the financial house is emergency fund. And this is 3 to 6 months. So what we do is we sit down with families and we help them build their financial house. We do that by educating. Income protection, by the way, this is life insurance, right? Emergency fund, 3 to 6 months. This is 3 to 6 months of living expenses. What we found, what has the industry as a whole done over the last, I don't know, 5-10 years? Have they done a good job of educating families on the importance of having an emergency fund? What do you think the most common thing that people say, what's an emergency fund? What do they use it?
Credit card.
Credit cards. Okay. That's not an emergency fund, right? But that's an average family I sit down with. That's how they're building their financial house. Emergency fund, not a credit card, right? Because it costs you too much money and you're not really sure it's going to be there for you, right? So 3 to 6 months, okay? Next in the financial house is a written plan to get out of debt. By show of hands, how many people in this room have a written plan to get out of debt? You know, your debt freedom date? That's awesome. That's awesome. Okay. Written plan to get out of debt. We look at this as a roadmap, a GPS, that says, takes you where you're at and where you want to go, where you want to get to. And if you're looking at something as important as building a financial house that's sound, it's not going to crumble all around you, be good to have it in writing. Be good to have a plan and spend time, working on that, okay? So we'll talk more about that, the written plan. And then, next in the financial house is your long-term savings. This is your retirement, okay? And we'll talk about the different options on that, and we're going to go through that. And then lastly, the roof is fun and games. And what we have seen is that people are trying to build their financial house roof first. And that's not working out very well, is it?
That's the American style, isn't it?
Well, we've been actually marketed to, the industry has spent a lot of money and a lot of time and energy marketing to us that this is a good way to go. But if you know anything about structural soundness, you know that you need a good solid foundation before you put the walls up. Then you put the roof on, you fill the contents of the house. So we're going to go through each of these. So let me ask you, we talked a little bit about Rule of 72, and a couple people had heard of it before, had knowledge of it. Einstein said that the power of compound interest is the most powerful force in the universe. Okay? And so this is something we should know. I mean, this is something. Okay, so we're gonna play a little game here, and I'm gonna hand out some money. Who wants $2,000? All right, Linda. Linda, I'm gonna give you $2,000. And Linda says to me, you know what? I'm really not sure what to do with this money, so I'm kind of afraid of losing it, and so I want to put it in a savings account at the bank, okay? So, because that's all Linda knows to do with it, right? So the bank is going to give her 3% interest.
No, it isn't.
Good point.
It's gonna give you 1/4% interest if you're lucky.
There you go. Now, the bank is going to give her 3% interest over time. So this is a long period of time. That's all she knows to do with her money. And so over the next 40, 50 years, her working lifetime, she is going to average 3%. Okay? So, given the rule of 72, she's earning 3% on her money. 3 into 72 goes how many times? This is like 5th grade math. 24. All right. So she starts off with $2,000. 24 years later, how much is she going to have? $4,000.
Linda,
Yes.
what happens when the cost of money rises faster than the interest rate?
That's a good point. We're going to cover that. That's a good point, Michael. Thank you. Okay. So, how long is it going to take for her money to double again? Another 24 years for a total of
$8,000.
$8,000. Woohoo! Linda, good luck in retirement. Okay? Work till you die. Work till you die. Okay. So,
It's my turn.
okay, I'm giving away another $2,000. Who wants it? Okay. Very good. Kimmer.
It's only 1,000, sure.
So Kimmer says to me, you know, I know Linda, and she's not really doing the best with her money. You ever said that? So maybe I'm going to do better. I'm going to put my money in CDs. Okay? So all that Linda knew to do was put her money in savings. Kimber Sue's going to put her money in CDs. And she's going to average 6% over her working lifetime. Okay? What's 6 into 72? 12. So every 12 years her money's going to double. So 12 years later, how much is she going to have?
4,000.
4,000. 12 years later?
8,000.
8,000. 12 years later?
16.
16,000. 12 years later? 32,000. Now let me ask you, how many of you would think, logically speaking, how many of you would think that Linda's getting 3%, Kimber Sue's getting 6%, so Kimber Sue's going to end up with twice as much 48 years from now as Linda? Logically, would you, that's where our mind would go. I mean, if you're looking at this, the average person, right, would think twice as much interest rate, twice as much. But what happens to this number? It quadrupled. It quadrupled. Why? The power of compound interest, okay? The most powerful force in the universe. And how many of us were taught this? a handful, right? And so, okay, I'm giving away another 2,000. Who wants it?
Barbara.
Barbara wants it. Okay. Barbara says to me, Linda, I heard about their mutual funds. How many of you know what a mutual fund is? Okay. For those of you who don't, it's where you pool your money together, right? So it's a pooled pot of money. Everybody invests their money in this pool pot of money, and then professional money managers invest that money into mutual funds, right? Into different funds. And the average mutual fund has between 200 and 300 different companies in it, okay? So rather than picking a stock and basically gambling on, placing a bet on a particular company or a particular industry, it is, 200 or 300 companies within multiple industries, and all the investors are pulling their money together as professional money management, okay? So over the last 50 years, our mutual funds have averaged 10 to 12% return. So for easy math, we're going to say 12%. So Barbara, 12 goes into 72.
6 times.
6 times. So your $2,000 becomes how much?
4,000.
4,000 in 6 years, okay? 8,000. 16,000. 32,000. 64,000.
128.
128,000.
256.
512.
256,000.
512.
512.
512,000.
I'm camping out in our backyard.
See?
There you go.
She's got $500,000.
So, Barbara has, how much did Barbara invest?
2,000.
How much did Kim or Sue invest?
2,000.
How much did Linda invest?
2,000.
So what I want you to see is the input for all of these was identical. But the output is vastly different, would you agree?
Yes.
So, who's controlling Linda's money? The banks. Who's controlling Kim or Sue's money? Who's controlling Barbara's money? Barbara.
The mutual fund person.
Barbara. She's choosing who to invest that with different funds. Okay? Professional money management. That's okay? Now, the way I look at this is a $500,000 mistake. When do we learn? When in life do we learn that we made a $500,000 mistake? When it's too late, right? So this is what we're working on trying to fix this. We're working on educating and because we believe that people of average intelligence, given all the facts and given the truth, will make good decisions, right? So let me show you one thing here. How many years was there between this right here? 6 years. And how much did Barbara make? $2,000. Okay? So she made $2,000 in 6 years. How much time is it between this and this? the same 6 years. How much did Barbara make? $250,000. It's the same time frame. It's the same 6 years. So, how soon do we need to sit down with people and educate them? Yesterday, right? And so, who doesn't need to know this? Is there anyone out there that wouldn't benefit from this? Education, okay? If you knew the rules, right? And you knew, what to do with your money, probably make good decisions. So, the number one thing I get is, yeah, well, Linda, we're kind of living paycheck to paycheck, and that's a good story, and that's a good theory, but where am I going to get $2,000? And the most common place that we get it, again, our job is to educate, when we do one-on-one appointments at the kitchen table, so we're kind of referred to as the Costco of financial services with home delivery, right? So we come and sit down at your kitchen table. We pull your numbers in and we do what's called financial needs analysis. It's customized to your plan. It's complimentary. And put your numbers in and basically show you. And how many of you in this room, how many of you get a tax refund routinely? Okay, what's the average, if you don't mind sharing, what's the average tax refund you get? Anybody? 3,000? 1,000? 2,000? Okay, the average, nationwide, the average income tax refund, nationwide, is $3,050. So, back to our 5th grade math, or maybe 7th grade math now, we've moved up. 7th grade math, how much is that a month? If you're getting $3,050 back for 12 months, it's about $250 a month, would you agree? $250 a month. So let's talk about this tax refund. When you get a check back for $3,000 or $1,000 or $2,000, whatever it is, $5,000, $14,000, right? I've seen them all. When you get a check back from the government, whose money is that? It's your money, right? It's money that you overpaid, right? You sent them $3,000 or $1,000, what? You sent them $2,000 more than you owed. Why'd you do that?
So you don't get a bill.
So you don't get a bill. Nobody wants to owe. Nobody wants to owe the government. So it's fear, right? Fear of coming up short. So we overpay throughout the year. We send the government, on average, nationwide average, we send the government $250 more than we owe them every single month. So, because we don't need that money in our budget. We're doing fine, so an extra $250 that month wouldn't have made a difference. Yeah, right, okay. No, we're just charging that difference on credit cards and paying the banks 18 to 30% interest. Okay, so awareness, right? We're overpaying $250 a month, and at the end of the year, they give it back to us. How much interest did they pay us on our money? None. Now, if we're going to go into the lending business, and we're going to loan the government $250 a month, we're going to loan them $3,000 a year, we need to do better than 0%, would you agree?
Yes.
Not a good plan. So, again, education, because we believe that if you have the truth and the facts, you can make better decisions. So let's say that we sit down with you and we find we find that $2,000 in your plan. We find that money and we put it toward building your financial house, okay? So if we found $250 a month that we could start to build your financial house, and we fast forward that 30 years, would that make a difference? Typically make a difference in most families' lives, okay? So we look at family A and family B. Family A just says, you know what, that's all great and wonderful, but I'm happy and I'm comfortable where I'm at, and I don't want to make any changes to anything I do, okay? They just go on business as usual, and, you know, and nothing ever changes. They never take any steps to learn or do anything to improve their financial situation. Family B takes advantage of the taxes. It's very, very simple. You change your withholding at your HR department. Doesn't cost anything to do that, and puts that money to work for them. Okay, and they start building their financial house, and they actually have financial wellness. Let's fast forward 30 years. Which family would you rather be? Family B, right? Okay. And before I get into my last topic here, I'm wrapping up. How am I doing on time? We're good.
Well, we're running a little over, but
okay. So before I get into my last topic, I'm going to wrap up. At the end of the presentation, John is going to be handing out two forms. The first one is just a form that has your name, address, phone number, and what you're most interested in. The other one is some things that you would have to have ready, for me to sit down with you. If for some reason you're not interested in an appointment, if you're not interested in learning any more about your finances and improving your financial situation, just don't put your phone number on there, because I'm not going to contact anyone who doesn't want or need, to benefit from this. Okay, so I just want to put that in there. Okay. My last topic is in this category of misinformed. The most misinformed area that we have is in life insurance. The industry has done a very, very good job of marketing to and educating different products in life insurance. And let's face it, life insurance is not a fun topic. Most people don't sit down and really talk about it for extended period of times. And I think that's the reason why there's so much misinformation. So basically, there's only two types of life insurance. There's what's called whole life, that has a cash value, some sort of savings account attached to it. And there's what's called term. It's just pure insurance, okay? Within the whole life and within the term, there's a lot of different names. There's a lot happening in here. But sometimes the whole life is sometimes known as universal life, variable universal life, you bet your life. I mean, there's the longer the name, the more confusing it is. Okay, just what we've learned. So let's just say, I'm just going to use this as a standard example. Let's just say that you have a whole life cash value insurance policy for $50,000. Okay, as a death benefit of $50,000. So if you die, the insurance company sends you $50,000, and you're sending them $100 a month for this. Okay, and let's say that you've had this policy with them for a long time, and you've managed to build up $10,000 of cash value within that policy. Okay, and first, let me just ask, what, for any of you in here who has life insurance, why'd you buy it? Anybody?
Security.
Security? Okay.
The trust bought it.
I'm sorry?
The trust bought it.
The trust bought it? Security?
Kids, house,
Kids, house,
income.
college education? Okay. So, this is typically what we get. College education for the kids is one of the main ones, and to leave something when you die. Okay, that typically
Take it home.
you're taking it all with you. Okay. Typically, when people buy it, it's college education plan for their kids. To leave something behind, estate taxes, right? To avoid estate tax, okay? So it doesn't eat your assets, your nest egg, okay? Typically, this is what we find. So, let me just ask you. We'll start with the college kids. Let's say that it's time for your kids to go to college. And the insurance company sent you a statement that says you have $10,000 of cash value in that policy. How do you get that money?
Borrow it.
You borrow it. It's a loan, right?
Right.
So, if you have to borrow that money and take a loan from the insurance company, whose money is that?
Mine.
It's yours?
The insurance company.
It's the insurance companies. Because if you went to the bank and you had $10,000 in the bank, would you have to borrow that out? Would you have to get a loan and pay them interest? No, right? Because that's your money. If it's in the bank, it's your money. But if it's in a whole life cash value policy, whose money is that? It's not your money. It's the insurance company's money, okay? So, let me ask you this. If this is you, you've got a $50,000 death benefit, you got $10,000 cash value in the policy, you've been paying $100 a month to the insurance company your whole life, and you die, what do your beneficiaries get? $50,000. $50,000. What happens to this $10,000?
Thank you.
They say thank you. The insurance company keeps your money. Okay? So, we've had people that say, I'm going to get back with the insurance company. I'm going to show them. I'm going to go take a loan out for $10,000, and then I'm going to die. I'll really get them. What happens in that situation?
They go up to the 50,000.
No, they just give me a state house.
That's exactly right. They subtract that $10,000 loan plus interest plus penalties, and your beneficiaries get a whole lot less than what you thought. Okay? Now, it's legal to sell this. It's legal, but I don't think it's very ethical, right? To pay for something, two things your whole life, and when you die, you get one. Everybody in this room, if I said to you, okay, if you said, you walk into a bank and you say, on deposit. I want to start an allotment to you. I want to open up an account, savings account with you, and I want to send you $100 a month. And the bank says, okay, that sounds good to me. And the bank says, okay, here's the rules. For the first 3 years that you send us $100 a month, we're going to keep all your money. That's our fees. That's our commission for you having an account with us. Is that a pretty good deal?
Oh,
After the 3 years, when you start to accumulate some money in that account, if you need access to that money, you can come in and you can borrow it back from us and pay us 7 to 8% interest depending on what the market's doing at that time. Are you going to be okay with that? No. And if you die anywhere along the way, we're going to keep your money. By show of hands, you tell me how many in this room would open a bank account with those rules? We wouldn't do it. But how many of us have been sold this because we didn't know how it works? We wouldn't, had the rules been explained, we would not have done it. Average, ordinary intelligence, given the truth, given all the facts, we would make different choices. Would you agree?
yes.
Okay. So, let's look at term. Well, there's 3 different kinds of terms, so you've got to be careful, right? The industry, the whole life industry, has learned that, oh, people are catching on. Yeah, they want term insurance. Okay, we'll give them term insurance. Ha! They're going to give them annual renewable term. Okay? How this works is the premium goes up every year because you're older, but the coverage stays the same. So this is designed actually by the insurance industry, to market this so that when the premiums go up where they're unaffordable, they can get you into this. Okay? Then, if you flip this around, there's what's called credit mortgage life insurance. And all this is the coverage declines, right? The coverage decreases as the years go by because you owe less on your house. It's just designed to pay off your house, which benefits who? The bank. Okay? So it's designed to pay off your house, but the premiums stay constant. All right? I have level term. And all that is pure term insurance. It's a death benefit that stays constant, and it's a premium that stays constant for the period of time. If you look, what is the textbook definition of life insurance? What's the purpose of it? Anybody? Okay? Cover your expenses. I'm going to read to you the textbook definition. To create an immediate estate in the event of premature death. That's the textbook definition. So let me ask you this. What's an immediate estate? It's a pile of money. Okay? Create an immediate estate, create a pile of money in the event of premature death. Okay? You die too soon, before you're expected to, before you're supposed to. So let me ask you, if you have a pile of money and or you don't die too soon, do you need insurance? Do you need life insurance? No. So, while you're building your financial house, and while you're accumulating wealth, that's when you need insurance to protect you along the way. Okay? Any questions on that? While we're doing questions and answers, because we're wrapping up, John's going to pass out those forms. So any questions on anything that I've covered? Everybody good?
Three names of the term.
The three names of the term insurance is annual renewable term, credit mortgage life insurance, and just level term, just straight level term. This level term works just like your car insurance. I mean, would anybody ever dream of adding a savings account to their car insurance? Say, you know, hey, you save this money for me, invest this money. No, you'd never do it. How about your home insurance? Why do we do it with our life insurance? Any other questions? All right, thank you very much. Appreciate your